We've got Arnab Das. He's the head of emerging market macro at Invesco. He joins in on a Skype connection. And on the phone line, we've got Peter Dixon. Gentlemen, good evening to you. And thank you so much for taking the time out. Well, Arnab, as we sort of wait to see what it is that the Fed is saying, especially in its dot plot, do you expect the Fed to reinforce a hawkish note today?
Yes, I mean, I think, the U.S. Oh, sorry, go ahead.
No, that's for you, Arnab.
Okay. Yes, I think, hawkish in the sense that the U.S. economy is quite strong. So the Fed is going to be signaling, I would expect more rate hikes, probably in line with the previous dot plot. I think another question is whether the market is going to fully price in the full scope of the medium dot plot, or continue to be more cautious about the long-term outlook. I think most people expect something of a slowdown in the economy in the quarters ahead because possibly the peak of growth, the peak of the fiscal stimulus is taking place now and in the coming 1 or 2 quarters in most people's minds. So I think the Fed will be hawkish relative to the market pricing, and then both the market and the Fed will be somewhat data dependent. We ourselves think that probably the inflation outlook is not as strong, even though wages have been firming, not going to be strong enough to drive the Fed all the way to where its dot plot currently, or most recently, has been. So we're a little bit more dovish than the Fed has suggested, and maybe a little bit more negative on the dollar, and therefore perhaps a bit more optimistic about emerging markets and other risky asset classes, at least cyclically.
Right. Peter, I'm still sort of going through it. What I know is the Fed has raised rates, removed a reference to the accommodative policy, and as Arnab, and actually the Fed dot is showing 12 of the 16 officials are favoring 4 rate hikes in 2018. So we know that, by the end of the year, by the time December rolls around, we're going to see another rate hike. What else, Peter, are you expecting from the Fed?
Well, it looks like they're still penciling in 3 rate hikes in the course of 2019, which I think, as Arnab said, looks a bit punchy, but it's not impossible. I think a lot depends on the extent to which, A, the fiscal stimulus continues to support the economy, which it's done phenomenally well this year. But I think as time goes on, as we just heard, that is likely to fade away. And B, the extent to which the tightening labour market is likely to lead to higher wage inflation. Now, over the course of the last 5 years or thereabouts, we've become conditioned to very low rates of wage inflation. But that could certainly begin to turn around if the labour market does continue to tighten at its current pace. So I think there are clearly risks to the market consensus, but I'm inclined to think 1 more rate hike this year and maybe 2 in 2019.
Hike, maybe 2 in 2019, but and with the U.S. short-term rates now rising to decade highs, the Fed clearly seems like sticking to its rate hike path. Do you see the dollar liquidity squeeze intensifying for emerging markets like India? Because, we're already sort of bearing the brunt.
Yeah, I mean, I think the dollar liquidity squeeze owes to a couple of different factors. One, as you say, the Fed tightening. Two, I think we've suffered a number of unexpected shocks in the course of 2018. We, and I think most other people, had been expecting the synchronization of global growth that had gotten underway quite nicely in 2017 to continue through 2018. And that's usually a signal that even though the Fed is going to tighten rates, other central banks are going to catch up to the Fed as other economies catch up to the US. And that tends to be a relatively dovish tightening cycle for the dollar because monetary policy differentials, interest rate differentials, and I guess in this case, the speed with which central bank balance sheets expand and then start to taper, that would catch up to the Fed as well. That had been the view going into 2018. Instead, what transpired was a significant slowdown in Europe and a significant slowdown, more sort of policy-led, in China in particular. And so most of the other large economies in the world were slowing down relative to the U.S., partly because of the fiscal stimulus and partly because of the intrinsic momentum of the U.S. economy. So that, I think, caused a lot of divergence which contributed significantly to this dollar liquidity squeeze. Also supported, I would say, significantly by the fact that the ECB's first rate hike was actually pushed out by a few quarters, right? So the policy differentials widened quite a bit. And then, of course, we've had all these structural issues of trade war and geopolitics and various other kinds of potential threats to growth around the world and growth in emerging markets in particular. So this combination of cyclical divergence and structural risks has caused this pressure on EM, one of the mechanisms for which has been the dollar strength. But like I say, if and I would tend to agree with Peter's assessment, right? We're going to have a few more rate hikes, but the rest of the world is going to continue to grow reasonably well, not least because the U.S. fiscal stimulus implies a quite strong U.S. economy, which implies quite strong imports, despite President Trump's efforts to fix, quote unquote, fix all these bilateral trade imbalances. So all of that should help limit the divergence in monetary policy, limit the strength of the dollar, and eventually limit the pressure on emerging markets. Some of those countries are, going to remain in, crisis or near crisis mode, but others, I think, what we're seeing is an adjustment that's led by the currency rather than an actual crisis. And I think India fits squarely into that category.
Well, Peter, so now we know for sure that the Fed has dropped its previous assurances that the policy is accommodative, and the median forecast is now saying and pointing to one more rate rise this year, followed by 3 increases in 2019 and then another in 2020. This is in line with previous expectations, of course. But Peter, I'm going to ask you pretty much the same question I asked Arnab, that as US interest rates rise, do you think that emerging markets are going to look less rewarding for investors?
I certainly think that's a possibility because, as we've heard, I mean, there are a number of factors swirling around at the moment. I think that the main issue here is, number one, to what extent will the U.S. continue to grow rapidly, relatively rapidly at least? And the answer there, I think, is it won't sustain its current pace, but it'll still look reasonably attractive to investors. I think the second issue, which we haven't really talked about too much, but I think is certainly out there in the markets, is to what extent will markets continue to hold up? Because I think there were a lot of concerns out there that U.S. markets in particular, but developed markets generally, remain very, very heavily valued. And if the Fed continues to tighten monetary policy, on the pace that it's suggesting, there might come a point at which you just tip over the edge and investors think, this is a good time to get out, particularly if the fiscal stimulus isn't boosting company profits to the same extent as it has done this year. And at that point, you might see a switch away from the likes of the DM markets towards the emerging world, but it also does depend, as Arnab said, on what other central banks do. Let's not forget that the ECB is another 12 months away from a rate hike at the very least, and also the Fed's tightening policy in a way which they don't talk about too much on the headlines here, but they're also running down their balance sheet. So there's a lot of monetary tightening going on in the United States. I think the dollar could, remain fairly well bid for another 6 months at least before we start to see signs of weakening come through once markets realize that other central banks are beginning to catch up. So it could be a while before, the EM markets benefit. I think in the short term they could face a further squeeze, but I think I'd be a little bit more optimistic on a 6 to 12 month horizon.
I also want to talk a little bit more about the outlook, the economic outlook in the U.S., thanks to the trade, skirmishes that we're seeing with China. But Arnab, before that, I'm going to take one question with you on India. Is it almost a given now that the RBI is going to follow these, the Fed move and hike rates next week?
Yeah, I think a number of emerging market central banks, including the RBI, are going to have to tighten progressively, following the Fed to a certain extent at least, because although they have in many cases floating currencies and inflation targets, including the RBI, so they should have monetary independence from the Fed in principle, the reality is that all of this dollar liquidity squeeze that we've already talked about is pressuring currencies and is pressuring inflation and inflation expectations and bond yields. And what the market is telling us through all of that is that those countries that are facing those kinds of pressures need to slow down. They need to adjust to a tighter external financing environment. and thereby avoid an inflationary fall in the currency and an inflationary growth process. And so I think you've seen that that tightening start to come through from a number of central banks. Those that have resisted, such as Argentina and Turkey, for very different reasons in those two cases, but nevertheless, one sort of common thread has been a relatively sort of unpredictable and probably inappropriate stance in monetary policy in those two countries. They've come under a lot more pressure and are facing a significant withdrawal of financing, not just a higher price for that external financing. So I think coming back to India, I think the RBI will hike and will continue to hike, at least to some extent, following the Fed as the Indian rupee comes under pressure, and that imperils the inflation rate and inflation expectations in particular.
Arnab, we are seeing stress signs in the currency markets here. There's also panic selling in equity markets, largely because there's this perceived worry about tighter liquidity conditions. I don't know if you've had the chance to sort of, delve deeper into some of the measures that the government has taken. I mean, for instance, just this evening, you had, New Delhi announcing import duty on at least 19 non-essential items, as they put it. Do you think, are these going to do anything to sort of not just prop up the currency, but also reduce the current account deficit?
Well, I mean, I think these kinds of measures are not the ideal response in my opinion for what that is worth. What I would suggest is, so the panic selling, first of all, in the equity market, a lot of pressure in the equity markets in India and in other countries, owes to this general global environment, and in this particular case, I think also owes to some specific idiosyncratic issues at the level of various firms and banks. And also at the general level of the need to continue with fixing the banks and recapitalizing them. Now, I think this response of intervening in certain areas of the market, I mean, I could of course totally understand why that is happening, and it's been used in very difficult circumstances in the past, even by the previous governor Rajan, in order to limit gold imports. But what I would say is, in my opinion, those kinds of sort of micro measures, really interventionist measures in different market segments, when you're facing a macro adjustment, as a substitute for doing all of this kind of monetary policy adjustment, and it's probably not a very good substitute, right? It probably won't avoid the need to tighten. It may help kick the can down the road a little bit. It may help reduce the external imbalance. But the reality is the external imbalance is rising because the economy has been growing at a phenomenal rate, right? The last quarter, you have the blockbuster 8.2% growth rate, plus the oil import bill is rising and contributing to a bit of a fiscal and current account twin deficit problem in the case of India. So I think it's fairly clear that those measures are, may be understandable, but they're probably not going to be necessary or sufficient to solve the problem, right? We're looking at a tighter monetary stance and a slower growth rate, at least for a while, at some point.
Peter, let's talk about, the prospects then for the American economy. Jerome Powell in July said that we don't see it in the numbers yet, but we've heard a rising chorus of concerns about businesses scaling back plans for capital spending as a result of these trade escalations. You had Harley-Davidson not very long ago say that, it's being forced to shift some part of its production overseas because it wants to avoid the EU regulatory tariffs. Do you see U.S. business delaying capital investment or moving manufacturing out of the U.S., in response to the trade war, which will, of course, hurt economic growth then in maybe the months to come?
Well, it might do. I think the way that we see the tariff wars at the moment are that the U.S. will certainly be the short-term beneficiary because, the U.S. can inflict more pain on the likes of China than China can inflict on the U.S. Now, that might not be true in the long term, but in the short term, I think it is true. And we're also hearing that, a lot of the smaller businesses are, very much in favor of the measures that Trump is putting in place because it helps to secure their market position, makes them feel more confident. I think business sentiment generally remains pretty good. I mean, obviously the larger international companies which trade across borders will suffer, and I think we will see a significant pullback in investment there. But overall, I mean, I think these two things are likely to balance each other out. The economy is likely to slow. Obviously, if something were to go badly wrong and the trade war were to escalate to levels which we're currently not expecting, then the risks to growth will be to the downside. But I think you have to look at this in the context as well of where the economy is in the cycle. We're already enjoying the second longest expansion in history. The Fed is tightening policy at quite a rapid pace. I rather suspect that we're setting ourselves up for a slowdown anyway, irrespective of what happens in the tariff wars.
Arnab, do come in on that. Like Peter says, in this trade skirmish war, whatever it is that you want to call it, with China, Donald Trump, at least for now, seems to have the upper hand. And it is seeming like this side with the advantage wants to prolong this war. In its July minutes, you had the Fed saying that a major escalation of trade disputes could speed inflation and cause, again, businesses to pull back investments. Do you think the Fed can actually, fight off trade tensions? I would imagine that is something, again, that Mr. Powell will talk about today in his press conference.
So I think, first of all, that much as I hate to say it, President Trump does hold most of the trump cards here, right? The U.S. is the largest importer in the world and has very large imbalances, deficits with most of the other large economies in the world. And of course, if you kind of have this implicit threat that there might be actual isolationism, I don't think we're going there, but there is this kind of implicit threat there in all this unilateralism and all this America firster kind of behavior and language. I don't think we can get there because the U.S. is not monolithic and President Trump can't simply impose his will. And of course, there are lots of checks and balances and lots of domestic interests, and not just the corporates, but the consumers as well, that will start to suffer and potentially make quite a lot of noise when and if inflation does rise. But nevertheless, if you threaten isolationism and you kind of step back and think, what does the world actually look like? The U.S. is a very large, very closed economy, with plenty of fresh water, it turns out, with plenty of energy, obviously plenty of guns and butter and physical and financial and human capital. And it also has a quite flexible, despite all the issues in the economy, it has a quite flexible, competitive economy with lots of firms vying with each other, right? Which is not all, that combination of circumstances is rare, if not unique, in the world. So I'm not trying to suggest that the U.S. can fully win a trade war, but I would suggest that in a full-blown trade war where we go to closed economy models around the world, isolationism, and so on, the U.S. would eventually be hurt the least compared to many other economies. So I think, therefore, in the short term, we'll continue to see concessions from U.S. trading partners in order to mollify this issue. But having said that, when it comes to the specific case of the U.S.-China trade tension, I would suggest that that's only one very important, but only one part of the story, right? The underlying part of the story is about technology transfer, investment, and indeed about geopolitics, right? And so I think that tension is likely to persist, and these issues in one way or another to continue to bubble up. So I do agree that there's a constraint there that implies challenges for global growth, not just for U.S. growth, but for global growth. I would tend to agree that in the short term, very much with Peter, that the U.S. is doing very well. Business investment overall is likely to continue to hold up. As we've both been saying in different ways, right? The U.S. large closed economy, most of the economy is domestic and small firms, and they seem to be doing very well. Small business optimism is quite high. So I think cyclically in the short term, the combination of the tax reform and the fiscal stimulus and some amount of deregulation suggests that the momentum in the economy will continue, particularly domestic small businesses, but that the large global firms that are sort of in a way choosing between offshoring and automation, this trade war may well give them some pause. And that, of course, is another risk to the S&P 500 and potentially, therefore, for other risky asset classes around the world. So the president is taking a lot of things on all at once. And it is a pretty risky strategy, but that's, I guess, the kind of president that he is.
We've also got Priya Misra of TD Securities, who's joining in on the phone line. She's joining in on this conversation. Priya, hi. Thanks for chatting with us. I think what everybody watching will want to know, what's going to happen with the rupee tomorrow. Are we expected to see it crumple even further?
Good point. I think, we've certainly have the Fed. We've just had a lot from the Fed 10 minutes ago. We're going to hear from Chair Powell in 10 minutes. I think right now the dollar is struggling a little bit because there is this concern around what the Fed meant by dropping the word accommodative. So now there's a specific idiosyncratic rupee issue, but I would say in general the dollar is weakening because the thought is maybe we're getting closer to the end of the hiking cycle. This is what Chair Powell needs to explain, because the market was getting pricing in a significant number of hikes in the following years, dropping accommodative to the extent that the U.S. is near the end of the hiking cycle. I mean, we've got all the other trade war issues, etc. But I think from the Fed, if the market is convinced that the Fed is about done, or a few more hikes and we're done with hikes, then I think the dollar is going to get into the secular trend of weakening because we've got enough fiscal deficit. That's actually good news, I guess, for the rupee or for general EM currencies.
Saying we're going to have to wait to see what Jerome Powell has said. But, I mean, from what we know in the statement, 12 of the 16 officials have favored 4 rate hikes in 2018. So that basically means we're going to see one more in December. And the 3 rate hikes in 2019, as was anticipated, pretty much stays. But, as the rest of my panelists were saying as well, it's almost done now that we're going to see the RBI next week hike rates, isn't it?
We are looking for a hike. I think... from the inflation standpoint, there's reasons for the hike to happen. I'm not even sure if Fed policy here would drive the RBI unless we get a very significant move in the rupee. But I mean, global growth seems to be resurging to some extent, and some of the EM concerns over the last month seems to have abated, and which is why the dollar weakened as we had the risk-on move. So I think that allows the RBI to hike without creating fears of, does that crimp the recovery in India? But, I think the question just is, with this trade war, can policymakers do anything? Can monetary policy do anything to offset it preemptively? Which I think we're going to hear from Chair Powell that the Fed is not going to do anything preemptively. And I think that might create some concerns if you have more hikes than what the market is comfortable with. But I think today's statement is suggesting that they're not going to rock the boat. And so they've kind of, they're justifying market pricing to some extent, which is why rates are actually a little bit lower. I mean, the Fed hiked and talked about more hikes, and yet rates declined, because I think taking out that accommodative word suggests that we may be well priced for all the hikes that are coming from the Fed.
So even if there's some comfort there, Priya, what about the fact that we've seen oil, at a 4-year high? Brent has crossed $82 after OPEC clearly is, showing no signs of turning the taps. What does that mean for the rupee?
Right. Yes. I mean, I'm not an EM strategist or specifically focused on India, so I think that could be a concern given the current account deficit in India. I think oil is a concern. Our oil strategists, though do not expect oil to continue to rise. At some point shale comes back in, and there's a natural cap to how high oil can go. So if you think, oil's topping out here, and at some point the trade fears do, or it actually starts having an impact on global growth, which is what we see, 6 months out, because there are lags in the system which will take a while for the trade tariffs to have an impact on global PMIs, then that also can provide a bit of a natural cap to how high oil can go. But if you're wrong and oil is heading to 100 next, I think that does hurt these oil importers much more, or disproportionately more.
Okay. We have, we're literally counting down now to the press conference, and so I'm going to take closing comments from all of you. And Peter, if I could ask you, what is it that you expect, Jerome Powell to be sort of emphasizing on in his press conference, which kicks off in about 2 minutes?
Well, I think he'd be saying basically, we are giving a view of the world which is not dissimilar to what we gave last time out. But the fact that he's dropped the word accommodative means, or implies, I guess, that the Fed is quite prepared to take rates above the equilibrium level. Whether it'll be quite explicit about that, I don't know. But that, I think, perhaps ought to give the markets pause for thought, because if the Fed funds rate does go above this so-called equilibrium level, around about 3%, then I mean that's the point at which investors, investor confidence might start to take a hit, and you might want to keep an eye on markets over the course of the next few weeks and months for indications that maybe the Fed is going to do what Rudy Dornbush always said they would do, which is to kill expansions rather than allow them to die naturally.
Arnab, what about you?
Yeah, I would tend to agree with what Peter just said in general. I mean, I think the big debate is going to be that when the Fed reaches its kind of estimate of the neutral equilibrium rate, R star, is it going to pause and wait and see a little how the economy then performs, and then decide whether to actually go restrictive at some point? And I think that explains the behavior of the curve and the dollar. That the market is expecting, maybe that we are nearing the end of the cycle, or at least a pause in the cycle, and that gives us a bit of breathing room. I think, of course, all of that depends on, as usual, on a host of factors, including the data outturns, particularly the inflation rate and the impact of the continued tightening in the labor market on inflation expectations. And like I said before, our assessment of that is that inflation, even if wages are firming, inflation itself is probably not going to go very far, and it's probably not going to get out of control, notwithstanding this kind of stagflationary risk that we've touched upon that might come out of the trade wars.
Right. And Priya, of course, you talked about, you'd be interested to know what Mr. Powell will have to say about why the Fed decided to drop the accommodative policy stance. But anything else?
Yeah, I mean, does he emphasize or de-emphasize the dot plot? Mm-hmm. Because, that's the one area where it shows a significant overshooting of neutral. If he de-emphasizes it and sort of reverts back to his Jackson Hole comments that we really don't know what neutral is, well, what if this is neutral, and what if they don't have to hike a whole lot more? And that'll be taken as extremely dovish sign. I doubt he'll be as dovish, but if he does de-emphasize the dots, I think the market will struggle to price in hikes much above neutral.
All right, Priya Misra and Arnab Das and Peter Dixon, all three of you, thank you so much for taking the time out.